You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at zacks.com.
Welcome to Profit from the Pros. I'm Terry Ruffalo. Investors were hit with more economic headwinds this week. The latest round of data didn't ease investor concern at all that the economy is headed down a rough path. The government reported that durable goods orders fell in April, even though there was an upward revision to the March numbers. We got word that U.S. home prices fell further in the first quarter, and weekly jobless claims jumped. As if that wasn't enough, the GDP report showed that the economy grew only at 1.8% in the first quarter. In other words, no change from the first GDP revision. And we'll talk more about that a little bit later on at the roundtable. There was also growing concern that Europe's debt troubles could get worse, and technology and consumer discretionary stocks were among those in focus through the week. Steve Reitmeister, you know, I asked this question a lot lately, but I'm going to ask it again. Why all the rocky road here? And I'm not talking about ice cream either.
Right, well, the rocky road because guys like you take mediocre news and make it sound bad, okay? I want to kill myself after listening to your intro. I want to kill myself. I didn't realize it was so bad out there. I think what we have to do is putting things in perspective. Have the recent economic reports been good? No. Most have been what I would call soft. Soft is different than saying they're negative. Most of these things are pointing to economic expansion, but they are lower than expected and not showing as much growth as we might like. Okay, so what does soft mean? Soft means that either we're going to continue to be soft for a while, what we might call the muddle-through economy, right, or soft means that the expansion is ebbing and we are taking a turn south and maybe continuing south. And that's where the fear is in the market, that softness leads to negative numbers, okay? Mm-hmm. I personally have been in the muddle-through camp the entire time. I think we're just going to have GDP that's around 2 to 3%, sometimes a little higher, sometimes a little lower, but never as robust as we would like. And that's okay for an extended period of time. If we keep doing that for a couple more years, we will eat away at the unemployment rate, we will have earnings growth, and we will have modest and reasonable stock price appreciation. So it's soft, it's not bad. There's a difference.
So as we turn the corner on the beginning of summer here, where's the market headed?
Yeah, I think it's going to just be a volatile summer because what we have here is a clash of the titans, okay? We have a clash between folks like me who think this is just the way it's going to be for a long time. It's just muddle through slow growth. And you have others who think it means that we are headed for the next recession, okay? Mm-hmm. And so as the two sides fight it out over every data point that comes in, we will have this volatility. So this week we are popping back up a little bit. And next week, as the new data rolls out, we'll see how people read it. But rocky through the summer, but I think as we come out and the clarity is there, then I think we will be extending to new highs as we get towards the end of the year.
All right, last week we talked about the importance of paying attention to insider trading activity, and I want to circle back to that again and maybe get a little more clarity on that. Why do insiders even buy their own stock?
Yeah, it's very simple. It is the greed motive. They want to make more money, and what's interesting is most of these insiders already own a boatload of their own shares, so why is it they want to reach into their pocket and put even more of their money at risk in the one singular stock? Yeah. And the answer is they think that the reward greatly outweighs the risk in doing that. So they know something is going on in the firm, whether that be new product launches, new sales strategies, new contracts coming, maybe even a merger in the wind. All these kind of things they know about before the rest of us, and the track record of insiders buying their own stocks clearly states they know what they're doing.
So you've identified some key elements in insider trading activity that can lead to some decent profitability. What are they?
Yeah, most people, I think, have had very false notions about what to do when it comes to following insider trading. So a lot of people have tried, but they usually miss the mark. The biggest mistake people make is they're trying to find the biggest insider purchases. And certainly I could understand the allure to that. But the bigger insider purchases are coming from the largest companies, and the largest companies are simply not going to have the biggest surprises in the future. Okay, so when Michael Dell bought $150 million of his own stock, that's exciting, but the stock's only going to go up a few percentage points on that move. It is about when small to medium-sized companies, when they have 2 or 3 or 4 people within that company reach into their pockets and grab $100,000 worth, $200,000 worth. So it's not about that $150 million, it's about the number of people within the company who know something good is going on, and even if it's a smaller amount of money, it works out very well. Do I have time for a little bit more?
Yeah, sure,
okay.
go ahead.
And then also the timeliness of the information. They need to report within 48 hours of their trades, and people are on that information real quick. You got to follow that information and act right away when you see it.
All right, thanks for that. More still ahead. Stay with us.
Here is your Bull and Bear Stock of the Week.
A healthcare company and a hair care company make up this week's Bull and Bear of the Week. Shiraz Mian, our research director here, once again to fill us in on both of these. Humana is the healthcare company. What's going on here?
Humana is as good a representative of the healthcare group as any, and I think it's useful for investors to gain exposure to the healthcare group. This group, along with the other counter-cyclicals and defensives, had been in the background as the rally was taking hold. But now that the macro picture a little bit moderating, the counter-cyclicals and the defensives are again in favor, and the healthcare group has been doing good over the last few months. And I think Humana it gives you a good exposure and play on that emerging cyclical rotation. The company is very well run. It's a good representative in the space. In addition to the commercial business, they are number 2 in the Medicare Advantage, and that in fact represents the best growth opportunity for the company initially over the last couple of years, as all the talk of regulatory changes were taking hold. Folks had written that particular business off of the company, but now we know that though it may be less profitable and low margin, but it's still a very growth-oriented, steady business for the company. So overall, a solid company, more defensive, gives you good exposure and good standing in an overall turbulent environment.
They get other government business as well from the U.S. Department of Defense.
That's right.
That doesn't hurt.
That's right. Absolutely. And in fact, one of the contracts was renewed recently, and that's another positive in the Humana story.
Regis is the hair care company, RGS the ticker symbol. What's going on with this one?
2 main reasons for having them as the not so liked company. And number 1 is the overall negative backdrop on the consumer end and on the retail end, and that is affecting Regis as any other retail-centric business. But even beyond that, Regis has been facing a number of secular challenges even before these consumer issues came up. The traffic to the malls and as well as their stores is down. The ticket sizes is down and lower now than it used to be. The cost base is essentially the same despite their really strong efforts, and as a result, their margins are getting squeezed. Same store sales, the comps, which is a key measure for all retailers, has been negative for Regis over the last 11 consecutive quarters. They missed again in the most recent quarter, despite having pre-announced. So the overall picture for Regis is very, very weak, and it doesn't seem like it's improving anytime soon. They were thinking of strategic alternatives, as they put it, but it appears that they have basically removed themselves from the market and want to go it alone and fix it themselves. But it will be a long, hard slog for the company. estimates are coming down, and that's a trend that we believe will remain in place for quite some time.
Yeah, that's never a good thing when you see that.
That's right.
Thanks for the information. We're screening for stocks next.
Screen of the Week, an overview of a timely strategy aimed at helping you become a more effective stock screener.
This week we're talking about the short ratio, and we're going to find out exactly what that means now from our top stock screener, Kevin Matris, who joins us here. And so I'll ask, what does it mean?
Yeah, the short ratio, it is the number of shares sold short divided by the average daily trading volume. And oftentimes this is referred to as the days to cover ratio because it tells you approximately how many days it would take for the short sellers to cover their position if good news were to send the market higher. And in general, the higher the short ratio, the bigger the potential price response could be, because the more shorts they have to cover, the more elongated the short covering rally could be, and that could really portend an explosive situation.
Okay, hence that phrase, cover your shorts. All right, so now I got it. So how is it used?
Well, typically an investor will look at the days to cover ratio, and they'll try to find a ratio of greater than 8 to 10, because in general it is believed that 8 to 10 days or more could be difficult to cover, and that could make a very big rally if people have to scramble to cover their shorts.
Sounds almost like a contrarian play. Do you have an example?
Yeah, it is kind of contrarian. For me, when I am looking at the short ratio, I'll often do so if I see a stock in a lengthy consolidation period. Okay. And one of the reasons why I'll do this is because when you're in a consolidation period, it's an area of indecision. You've got people making bullish bets, bearish bets, and they're waiting for a catalyst. Well, if the market were to break out to the upside, people who are long are probably going to add to their position. People who are on the fence are probably going to now get long for the very first time. And people who are short are going to have to scramble to cover their shorts, i.e. buy, and that can send the market up even more.
Can you use this when the market's going down too?
Yeah, you can use it in all different types of environments. When the market is going down and everybody is wondering if the market has hit bottom, you can use the short ratio as a way to uncover extremes. On the flip side, though, when the market is going up, you can use that too, because if, let's say, a stock is going higher and let's say it goes through an important pivot point or an important moving average, the short ratio can be a trigger for additional buying, especially if funds are coming in. As these big buyers come in, now you've got the market moving aggressively, and now all of these shorts are panicky, desperate to get out, adding more buying to that scenario.
All right, take us through the parameters.
All right, here we go. In this week's screen, we're looking at the 12-week percentage price change to be greater than or equals to 20%, so we're looking for stocks that are moving higher. Mm-hmm. We want the current price divided by the 52-week high to be greater than or equals to 0.80, so stocks trading within 20% of their 52-week high. Then I want the projected growth rate to be greater than the industry median. I want the short ratio to be greater than 10, right, more than 10 days to cover. Mm-hmm. And I want the current short ratio to be greater than the short ratio from 1 month ago, so I want to see increasing bearish bets on those stocks.
Some stocks that came through.
A bunch of stocks came through. Here's 5. Echo Global Logistics, Glatfelter, Liz Claiborne, Sally Beauty, and Sequenom. All of these stocks are moving higher, or they are in consolidation areas, but there are bigger bets that the stock could go down, and if it does go up, you could see a lot of short covering buying.
Do you own any of these?
No, I don't.
All right. And you use this more than once a year?
Yeah, I run this thing kind of regularly. I would say maybe once a month or so.
Cool. All right. Roundtable's next. Oh, that popular roundtable. Don't miss it.
Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com.
Fear Factor is back. More and more economic reports coming up weak lately, and I'm not just trying to make it sound like it's the end of the world either, like we said at the beginning of the program. But anyway, we're going to find out from our panelists why that is and what happens next. Steve Reitmeister, editor-at-large, back with us once again. Shiraz Mian, research director, and market technician Kevin Matris, and I just said that because he gave me grief at the beginning of the program.
It's the end of the world.
Yes, people they always pick on the messenger. I don't understand why.
Well, you took all the economic news and made it sound as horrible as possible, and there was like horror picture music playing in the background. At least that's what I heard. And so
I would have been a great Alfred Hitchcock protege.
yeah, absolutely.
All right, we all saw the GDP report that came out this week. We don't have to belabor the point. You kind of alluded to it at the beginning of the program. You're looking for muddle through here, and this report would seem to support that theory.
Yeah, 1.8% is on the low side of muddle through, but it was a little disappointing that we did not get the revisions that we expected. A lot of people were saying 2.1 was going to be the case. So I don't think that that news was bad news, as in, oh my goodness, here comes the other next recession. It's just kind of like, it's not as great as we would like, but 1.8% growth is better than less than 1.8% growth.
I mean, is it just as simple as that? Shraz, earlier this week you wrote in some of your commentary that there are still some major positives to the U.S. economy.
There are positives, but just to put a little bit of a negative spin on what
it's not as simple as that, he's saying.
We are not getting into a recession, that is true. A 1.8% GDP growth rate is not the end of the world, that's true too. Mm-hmm. But the expectations in the market were for 3.5% growth for second quarter and beyond. Mm-hmm. And if we are bringing those expectations down, that is a material negative event for the market, for commodities, for currency, and for all of those things. And that is the key issue that the market is trying to size up now. Okay, Q1 is behind us now. It came at 1.8%. Right. That's past history. What about going forward? And it's the sizing up of the second quarter and beyond that is really agitating the market right now.
But give me a couple of those major positives that you wrote about earlier.
Earnings were spectacular. Yeah. Despite the fact that you had a 1.8% GDP growth rate, you had corporate earnings that were pretty much in line with what we did in the fourth quarter of 2010. So awesome earnings, balance sheets are very good. The Fed, despite the end of QE2 next month, interest rate still remain quite supportive. And if this labor market improvement trend that we've been seeing over the last few months, if that remains in place, then it has all the making of putting the recovery back on track in the second half.
Right. All right, Kevin M., what say you? Muddle through slow growth or further weakness?
Let me build on what Shraz was saying. I do believe that the one thing that is clear is corporate profits. Corporate profits are at record highs. Just this week, there was a corporate profits report, and they said that on an annualized basis, corporate profits are at $1.45 trillion. That's a record number. That's a 5.6% increase from last year at this time. So if you look at those numbers, you can see businesses are growing, so you can say jobs should increase, the economic reports moving forward should get better, there should be a rise in GDP, and I believe that that will help support the market. That is what I think is the takeaway with all of this stuff this week.
Let me just add one more thing into this mix, because I think it's the most important one. Since we've come out of the Great Recession, half of the quarters have been below trend growth. And what's a trend? 2.7%, I believe they say that's at. Or some people just round it off and call it 3, right? So we've been below trend growth most of the time, and yet earnings growth has been excellent. And so what I'm saying is that the 1.8 is still supportive of good growth, and that if people are going to lower their expectations for the future of 3.5, and even some crazy as 4%, which is not going to happen, it doesn't mean that corporate earnings won't keep going higher and that stocks can't keep advancing. It's just that the easy money is off the table, okay, the big advance from the bottom, but we can still have high single-digit kind of annualized returns, and if you do your job right, you can get into the double digits.
That's right.
Yeah.
So, did you have something you
wanted to add? I was
just
going to say, the G8 just came out too, and they said that they believe the global economy is on a more sustainable path. So, since we really have a global economy, everybody else on a more sustainable recovery path is going to make everybody else see better economic growth in their own countries.
Yeah, I read earlier this week where other countries' economic growth is going to be slow as well. So they're experiencing slow growth abroad just as we are here. So it would seem to bear out your theory that this is not something that's abnormal.
No, it's not abnormal. Here again, we want better. Okay,
Right,
we want
sure.
better, and the market is kind of built upon expectations. But once the expectations come in line, and then people see where earnings are, and here again, that the return they will get in stocks is better than cash because the return on cash is zero. I mean, real, right? So you might as well take a shot at being in companies that are having some level of growth and some level of price appreciation. And what's the average dividend yield on the S&P 500? About 1.8%. Better than cash.
All right, top stock pick.
Top stock pick, Apple. I know it's kind of boring, but I'm just in shock how this company could be trading at a PE of 11. Okay, when you back out the $70 in cash and you take a look at the current earnings, PE of 11 makes no sense. It should be 15 to 18 minimum. It is my largest position by a mile, and I'm not going to be satisfied until it's 450 to 500.
Shiraz, quickly.
If Apple was boring, then I don't know how to describe Echo. That's an agricultural company. It's an agricultural machinery company. It's a play on the positive outlook for the agricultural commodities. Farmers are feeling flush with cash, and that just adds to their ability to buy this machinery. A very good stock.
Okay, Kevin.
Foot Locker, that's exciting. So they do athletic footwear, apparel, and all this stuff. They have operations everywhere around the world. The thing that I like about them is the shoe industry is doing fantastic. Foot Locker has double-digit growth rates. If you look at a chart, it looks as if that the price target is $30. They've already broken out, but there's a lot more to go. That is a 21% increase from where we are today.
How reflective are they of the retail atmosphere right now?
I think they're very reflective. But again, there are certain areas that are doing good. Luxury and apparel and shoes, all on fire.
All right. Well, thank you all for your time. And we thank you for being with us as well. Have a great Memorial Day weekend, and we'll see you next time around here on Profit from the Pros.